Oscar, great. Thank you very much. Welcome all to this first afternoon session, first panel on revenue security. I think this morning was a great build-up, actually, to the session that we will be having now. We talked quite a bit about bankability of projects already, the various risks that these pose, and the various risks that investors need to weigh in order to be able to understand whether projects can be financed. So I'm Ausilio Bauen. I will be your moderator for this session. I'm a partner at ERM. ERM is a global sustainability consultancy. I'm part of our low carbon fuels team. Our team works on a wide range of issues related to SAF. We support companies with growth strategies on the supply side and on the demand side. We do a lot of technical and commercial due diligence on projects for financiers. We've assessed, I think, up over 80 projects, SAF projects actually to date. So we have a wide range of experience across different technologies. And we also go all the way down to helping with concept development and project implementation, so feasibility studies and supporting some project implementation activities. So that's a bit about myself and about ERM. I'd like to maybe now hand over to our great set of panelists and varied set of panelists that will take us through the discussion on this topic. So maybe I'll start from my right here, Geraldine, if you can, maybe each of you can briefly introduce yourselves and your organization and the perspective that you bring to the SAF space, and then we'll go on to some Q&A.
Sure. Hello. Good afternoon. Not easy to start after lunch, but we'll try to keep you awake. I'm Geraldine Pic-Paris. I'm working for ATOBA Energy, a new position, a new position in the SAF market. Actually, we are here. We are a commercial aggregator of SAF, so supplying from producer to help them to pass their FID, and then we're selling to off-takers. But I think we will go a bit more into detail of aggregation a bit later. And yeah, thank you. Over to you, Michele.
Thank you, Geraldine. Thank you everyone for being here and listening to us after lunch. So I'm Michele Verde, Vice President at the Royal Bank of Canada. So we are the largest investment bank in Canada and amongst the largest ones here in Europe. And what I do is I specialize on advising our clients, which are mainly infrastructure funds, on mergers and acquisition, and from time to time equity capital markets or capital raise transactions in the energy transition space, with a special focus on SAF. So we cover very well the space. We advise Macquarie Asset Management on their investment into Sky Energy a couple of years ago, and we are about to announce another transaction anytime soon. So we're very excited about that. Thank you.
Hello, my name's Gaynor Hartnell. I'm from the Renewable Transport Fuel Association, and the RTFA is the trade association representing UK renewable fuel producers, and that covers the spectrum of renewable fuels, bioethanol, biodiesel, renewable diesel, biomethane, etc. And I'm glad to hear that those got a mention earlier on today, because of course they're all part of the same family, and very important in that the SAF mandate we've got in the UK is very largely based on the road fuel mandate. So it's helpful for us to have that wide view when we're giving advice to our members. So in terms of our members and our role in the SAF industry, we have 20 of our 60 RTFA members are involved in SAF. They're mainly project developers in the UK. Some are overseas producers looking at the UK market because it's so interesting. And we also have the only actual manufacturer producing SAF right now in membership as well, Phillips 66, whose Humber refinery is producing co-processing SAF. So yeah, and virtually since the moment we were established, which was the autumn of 2020, we've been calling for a revenue certainty mechanism, and we're finally making progress with that, and the extent of the progress will probably come out in the discussion. So that's what we do.
Thank you. Hi, everyone. My name's Alex Harrison, and I'm co-head of what we call our projects and energy transition practice, as well as sustainability at a US law firm called Akin. My background is in project finance, so ultimately my interest here is in how we can attract large bank capital to leverage the delivery of SAF projects. My experience in the market today has been focused on the offtake side in particular. I've done a number of deals for Southwest Airlines buying SAF, pre-FID and pre-financing. Happy to talk about aspects of those deals as we get into the discussion. But I've also done transactions in the sort of scope 3 kind of carbon credits space, both to trade those, but also to try to establish platforms through which you could try to sell category 6 scope 3 attributes to business customers and that sort of thing. Pleasure to be here.
Good afternoon, everyone. I represent iFuel. Our company is based in Saudi Arabia. I'm based in London. More than 20 years of experience in aviation and energy industry, including refining for conventional oil, and we trade now and sell jet fuel to commercial airlines, cargo airlines, business jet companies, and we trade some spot for SAF, so physical trades mainly, and looking now to maybe into some long-term offtake agreements. So nice to meet you.
Perfect. Thank you, Grazvydas. So we should speak closer to the microphone, I'm told, to make sure that everybody can hear in the room. So we touched upon different risks this morning in relation to SAF projects and their bankability. I think revenue certainty came up as probably the leading risk in terms of getting to financial investment decision. But I'd like to start with and I think on this panel, what we'd like to explore really is why it is an issue and how it can be mitigated ultimately. That's what we want to get to the bottom of. But maybe I'll start with Michele. And Michele, ask you, why is revenue certainty specifically an issue for SAF projects?
Thank you, Ausilio. And this is a crucial question. We want to ask ourselves, really, what is driving the project bankability and why is it so crucial? So I would like to answer the question with two key issues. But before we go to those, I'd like to offer a perspective from what I see when talking to investors. First of all, we see a lot of support for SAF from the investment community. As I said, we advise the Macquarie Asset Management on their investment in Scanergy, and we see another transaction on the line coming soon to be announced this week. And why is that? That's because SAF has very strong ESG credentials. It has very strong government support. And most of all, it's starting to create that right balance between risk and return. So what are the two key issues that really are behind the security of revenue? So first of all, SAF is expensive. We all know that. SAF basically is 2 to 5 times the price of jet fuel. Only if we consider only the cheapest way of producing SAF, which is HEFA, only the feedstock is about $1,200 a ton, while a ton of conventional fuel is about $800. So only there you have a raw material that needs to be processed and needs to be and is already more expensive than fossil SAF. So a key solution to that is revenue certainty, and is the solution that allows basically for projects to progress. And that brings me to the second key issue, is that revenue certainty is the key pillar in a project. It drives everything. It drives capital expenditure estimates. How do I know if my project returns enough if I don't have revenue security and if I don't have revenue certainty? Also from a volume perspective, I need to make sure that my volume is off-taken. How can I secure financing if the banks don't have the certainty that someone will take this product, which is 2 to 5 times more expensive than fossil? Or how do I locate my project in Europe or anywhere in the world without knowing how much it's going to cost and how much I'm going to make out of it. So overall, what we're seeing is a development towards this revenue security through offtake contracts or through aggregations, like in the case of Geraldine and ATOBA Energy, that are giving the confidence to investors to have a baseline and to banks to finance those projects.
But how is revenue certainty affected by the feedstock and the pathway? Because I guess it's all about also price transparency to some extent in the market. I think that affects the visibility on potential revenue, or allows you to make some hypotheses on what your revenue can be. And I guess that for HEFA, we are starting to have some price transparency in the market with published HEFA prices, etc. But for many of the other fuels, we don't really have price transparency. Can you comment a little bit on how revenue certainty is affected by maybe different types of feedstocks and pathways?
Yes. So many of you will be familiar. So many of you will be familiar that HEFA, as you just mentioned, i.e., the use of biomaterials, which are second generation. Like imagine the used cooking oil from your local McDonald's. That is commonly traded, as you mentioned, and it creates, let's say, less of a price certainty issue. But you still have all the processing costs, and different plants in different parts of the world have different processing costs. An example: I was having a conversation over lunch just now, and someone brought to me the example that developing a project in India is probably about half the price of developing a project in Europe. So it's not just the cost of feedstock; it's also the cost of developing the project. And for those, let's say, more complex pathways, imagine ESAF. Well, the way we see that is best solved is, again, through private offtake contracts that have certainty upfront. And that certainty, as I was mentioned before, pulls all the other items, pulls the capex, pulls the location, pulls the economics, pulls the financing. So really, those contracts which have price mechanisms written down in formulas are the key drivers to achieve that certainty in our view.
Thank you. Thank you, Michele. Geraldine, maybe then over to you. We've talked about the challenge with revenue certainty. What types of private and public sector initiatives or mechanisms do you think can help in terms of providing greater revenue certainty? I guess it's a mix of things that need to come together, and it would be good to have your perspective on that.
Indeed, revenue certainty is key to unlock the investment in the SAF production, and mainly because investments are huge and return on investment also very extremely long. So on the public side, so there are some, of course, we know the mandates are here, subsidies, tax credits in the US, but also some mechanism like public purchase agreement or that give at least a minimum demand. And this is not enough, or contract for difference even. But this is not enough, and we need to have some additional private initiatives or mechanism, and offtake long-term agreement with credible buyers is key, but also, as you were mentioning, Michele, price mechanisms such as indexation or shared risk mechanism in order to assess or to address this carbon market or regulation evolution. So you have specific clauses like pass-through or flow-through indexation, partial index or hybrid indexation even. And this is what we do actually in ATOBA.
Can you explain maybe to us a little bit your business model in ATOBA and how it helps with the revenue certainty, with providing revenue certainty to projects?
Yeah, we are positioned as a commercial aggregator, and with the mission to connect fragmented demand to bankable, and we talked about a lot about that this morning, to bankable SAF offer through structuration of contracts. And so we structure long-term offtakes by aggregating the demand with airlines, with parties obligated to mandates, or even with corporates. And we build those contracts with credible contracts with concrete volumes, secured volumes, but also with this quality of credit, with this aggregation model, sorry. So this is what we do. And those contracts, we are using pricing mechanism, which provide flexibility, and we have a partnership with General Index by contributing to creating an index on SAF in order to give more transparency on the market and give confidence to investors. And this is what we do. Also, just a last point, and after I give the floor to the others. In our contracts, the flexible mechanism is important, so we could start with fixed pricing and then switch progressively to indexation as soon as there is more maturation on the market. And this is what we do.
Okay, and in your model, who's the bearer ultimately of the risks then in relation to the offtakes? Yeah.
Well, actually, the demand aggregation is securing the supply, so it's a back-to-back model.
Okay. Perfect. So there's a mix, as you say, there's both need for private sector initiatives in terms of market intermediaries bringing the supply and the demand side together into these contracts, sharing those risks. There's a public sector role, I guess, in that as well, in terms of you saying providing that support, bridging that gap. Maybe at this point, I think it's good to bring Gaynor in, and Gaynor, maybe you can tell us a little bit about the revenue certainty mechanism in the UK, but most importantly, I think, can you tell us why a revenue certainty mechanism is needed, actually, especially if there is a mandate? A mandate should send the signal that offtakes are needed, and people should be willing to go into those offtakes, buy that SAF, and the market should work. But why do we need a revenue certainty mechanism?
Yeah, that was the hope. That was the Department for Transport's hope, and we had to keep telling them that the various messages, the numerous reasons why some sort of revenue certainty mechanism is needed. Well, first of all, we heard from Michele about the cost is largely made up of the kind of premium that you get for the environmental credentials of SAF. So in our case, in the UK, the greenhouse gas certificates make up such a large proportion of the revenue stream coming into a project, and that price will be variable. So if you take the renewable transport fuel obligation, the road fuel mandate, as I was saying earlier, on which the SAF mandate is based, those renewable transport fuel certificates, the RTFCs, the price fluctuates, and we've not had a very good history in the UK of actually building domestic projects here in the UK. And sadly, those that have been built are experiencing a really heavy situation, or challenging times at the moment, really serious. So that doesn't bode well. And just about every large infrastructure energy project in the UK will benefit from some sort of contract for difference or equivalent certainty mechanism. Even well-established things like wind farms, offshore wind farms, etc. But our Department of DESNES, as it's known, of energy security and net zero, it's got a range of different schemes for revenue certainty. This RCM will be located in the DFT rather than that department. But, so it's established. People kind of come to expect that. But added to that, these are first-of-a-kind projects, so you've got all of that extra risk on top. And a mandate for fungible fuels won't guarantee you anything is built in the UK, and the UK isn't, a particularly cheap place or cost-effective place to build a project. So if we want to have domestic manufacture, a mandate won't encourage that. All it does is create the demand, which could be satisfied from anywhere in the world. So if you want the domestic manufacture, which we do, the government wants, then the revenue certainty mechanism is essential. And plus, it lowers the cost of capital. So if you want to bring the cost of the SAF that's produced down by having access to cheaper finance because it's had that risk of the revenue stream taken away, then that helps as well. I think that's a good list of reasons, and but it did take a long time for us to get that understood and accepted and finally legislated for in the UK.
What are some of the key features of the revenue certainty of the UK revenue certainty mechanism in terms of how the pricing is set and where the where the funding's coming from?
Okay. If I've missed out any bits, just ask me subsequently. So the price, the cost of this revenue certainty mechanism will be the difference between the achieved sales price, the amount that the SAF producer gets paid for their SAF, and the strike price, which is the price that they actually get for the SAF that they produce. And of course, it has to be linked to the greenhouse gas savings or the carbon intensity of the fuel. So so it tops it up to that strike price. And if there is a difference there, then that will be paid for, and it's recently been legislated, the bill laid in Parliament to enable the government to raise a levy, it will be paid for by aviation fuel suppliers. There was a consultation recently on who would pay, and it kind of set the expectations. It's kind of, we're hoping it will be a number of rounds, contract rounds, but initially it's kind of starting small, perhaps, see how it goes and then grow it. But there's mention of literally a handful of first-of-a-kind projects this will be supporting. So I've done who it's paid for, who pays for it. It's only for the non-HEFA projects, non-HEFA SAF projects. It mentions in the consultation that there are challenges to having the revenue certainty mechanism supporting eSAF projects at the moment, but that something needs to change on either the buyout price or something else to enable those projects to be kind of bought into the mechanism, which of course we're working on very hard at the RTFA to get that ambition level increased.
Perfect, thank you. Thank you. Now, in a few minutes, we'll be also asking for questions from you, the audience. So if you have any, you can already type them into the app, or otherwise we'll also take some questions from the floor. But it's all about also. I mean, this whole process of revenue certainty will lead us through a process of price discovery, right? And I think that's ultimately we were saying we want to get to some form of price transparency, some form of indexation, so that revenue can become clearer and clearer to people as projects are being developed as we move into the future. But Grazvydas, with your based on your trading background, it would be interesting to get your view on how you think revenue certainty mechanisms will have an impact on price discovery, will have an impact on price transparency.
Thank you for this question. So, listening to my colleagues, the question is almost answered, what I can say. But I can, and it's only we're talking about non-HEFA, because as Gaynor mentioned, it's a revenue certainty mechanism currently we're speaking about is mostly for non-HEFA. But I can just, hopefully I will not be repeating myself, but just saying that, currently, without the government support, SAF price is largely a product of market forces. So feedstock volatility, energy costs, and ad hoc offtake deals between producers and buyers, mostly airlines. But when revenue certainty mechanism is introduced, the current pricing dynamics, of course, will be affected. And my best guess, which was already mentioned, is that strike prices could help establish reference points, enabling emergence of benchmarks and possibly future markets. So in short, revenue certainty mechanism doesn't just stabilize prices. It could unlock scale, competition, and innovation.
Perfect, thank you. Also, if there's any comments from any of the other panelists on any of the points that have been made, please do chip in. But so it will ultimately, yes, be all about, let's say, getting the price right, getting enough certainty around the price, and clearly, a big element in terms of pricing are the offtakes. But there may be other things that will increasingly play a role on pricing, which could be SAF certificates. And that's, I think, something, Alex, that you've been looking into a lot. It would be great to have your view on, how you how you're seeing offtakes, being structured. How do you see offtakes in relation to, revenue certainty mechanisms? And also, what could there be? Could there be when we're talking about environmental attribute certificates like SAF certificates? How do you see them potentially complementing the revenue from the physical offtakes?
Thanks, Ausilio. And I think it's a sort of well-traveled question about how you think about revenue certainty in the context of a bankability analysis or a project development. But I think there are some specifics that certainly we've encountered in relation to SAF that are worth kind of highlighting here. So start with a focus on volume risk, because I think there is a question about how much volume an airline wants to purchase at any given point in time. It may be that they can purchase all of the volume from a plant very comfortably, but when I've looked at projects that are linked to particular airports, particular locations, if historic flight patterns suggest that in a downturn there may not be demand for that fuel in that location, that becomes a factor in terms of, is there consistent volume demand for that fuel? And I think also on the volume side, there's a question of, I think, subsidy chasing or attribute chasing, i.e. how can you monetize these projects in the most successful way? That might mean that over the life of a deal, it becomes more successful to move a volume from one airport market, for example, for the US projects that I've looked at, California, where there are profitable subsidies available today, to the other side of the US, to the East Coast, where new subsidies may be introduced that become more attractive for that SAF. So I think volume is a question of which airline, where do they think they're going to need it, but also where are the most profitable ways to monetize the product going to be. And so building that into an offtake from the outset has additional complexity, because I think in most long-term offtake agreements, it's pretty clear which asset is going to use the fuel that is being delivered. Here, I think you have a degree of uncertainty about the airport destination and also about the volume. So you need to get a bankable counterparty to take volume risk, but there's a bit more complexity to the analysis. I think you've also got a question on sort of reliance on feedstock suppliers. Can the developer be certain that it will be able to secure the feedstock in the volumes and the quality that it requires in order to be able to produce a SAF? Because no revenue certainty mechanism is likely to take away volume risk at all or entirely. So you're going to need to produce SAF. If you can't produce it because your feedstock disappears or your supplier goes bust, what is your solution? And in this constrained market, that isn't an easy answer in lots of circumstances. And then what if you just have production issues? What if you've got a commitment to buy the fuel, but you can't produce it because you're encountering technology risks, or you've inadvertently agreed to a spec that you can't match? And in that context, is the spec that you're required to deliver to a Jet A spec? So fairly conventional, everyone understands it. Or is it a Jet A spec with a layering of sustainability attributes that you need to deliver to the airline in order that it can make the Scope 1, the Scope 3 claims that it wants to make? So if you've got those sustainability characteristics and for some reason you can't satisfy them, does that render all your fuel off spec and effectively invalidate your volume commitment, invalidate your offtake solution? So we often see take or pay arrangements that are trying to deal with volume risk, but they will have certain circumstances where they don't kick in, where the producer's in breach of contract, where force majeure has affected the off-taker's ability to take. So how broadly those exclusions are drafted will impact the analysis and bankability. So that's kind of volume risk. I jump to sort of price risk. I mean, obviously there's a big question there. That's obviously where people focus when you talk about revenue certainty. Are we talking price floors? I've certainly done deals with price floors, but they tend to be asking airlines to take risk on the value of the attributes that sit in the deal. We will sell you sustainability attributes, you can monetize them, you can use them, and we want you to underpin a price for that. That was great and is great where you have confidence and certainty in a market, but if you look at the US now, what was a very valuable piece of paper under the Inflation Reduction Act or state subsidies a couple of years ago is now potentially at risk of being withdrawn altogether. So how do you cater for that kind of risk in a transaction? I think counterparty and covenant risk is also key. You can have the perfect contract, but is your airline actually worth the paper it's written on? What's the risk of that? What's the credit standing behind that? What credit support can you get to enhance that risk? And what alternative solutions do you have? If for any reason your route to market disappears, is there a pivot? Is there an alternative market? And particularly when you're looking at international alternatives, does your SAF qualify to be exported to other markets? Is it economic to export it? So do you have a revenue certainty backstop if you lose your primary kind of route to market? And within that, as you say, Ausilio, there's the question of how much the attributes are factored into the bankability base case. And I would say basically not. I think they can't be until there is some certainty as to their value in the market, and that is not present at the moment. So they may be icing on the cake, they may be equity upside. I've certainly seen airlines trying to take that risk in early deals, but I think as the market has matured, people have begun to understand that the change in law risk that sits around this space is really quite profound. And it's very difficult on a long-term basis to commit to an uncertain outcome in those respects. So I think quite a complicated conundrum and quite a few kind of SAF specifics that need to be worked through before you can get to what should be ultimately a conventional kind of offtake, committed offtake with a firm price that people can lend to. But you need to work through some of that detail to get there, I think.
Yeah. So a lot of sharing of risks that need to happen between the different private sector players, potentially the public sector through the revenue certainty mechanisms. And something we haven't touched upon and won't have the time to touch upon is the financial backstops that may be needed in all this in terms of guarantees, etc. And that will be a critical element, I think, to this. It can be in the form of EPC wraps, but they won't go far enough. You will need other guarantees. You will need other financial backstops. And that's, I think, another element of the picture. But let's go on to some of the questions quickly now from the audience. Maybe if we can get some very brief answers. Let's start from the one where there was one that was asking how quickly it could take to get to an index. And maybe, I don't know if, Grazvydas, you could reply to that one there. In the case of, for example, eSAF, we don't have a price index today. How quickly could we see a price index emerging? Maybe based on the experience with other sectors like, I think LNG, ammonia were mentioned and others.
Yeah, so it's maybe from practical experience today, we are talking to some non-HEFA producers for the head of terms for the offtake contracts. And I can say responsibly that there is no indexes. It's a cost base plus some adjustments over the 10-year or 15-year period. So to answer this question, a question is it needed right now? Yeah.
Yeah.
Because the banks which are quite a significant part of these head of terms of offtake agreements, they prefer this mechanism at this point. Yeah? But let's see how when the demand increases and the supply increases for the non-HEFA.
Yeah, Geraldine, quick view on that, and in the meantime, if we can bring up the other questions, I'll have a quick look.
There are a lot. How quickly? It depends also. index. There are a few on the market for HEFA and more coming. What is key is having transparency, and as soon as we have production starting, that will provide certainty on production costs. So how quickly, it will depend also on the evolution of the market. I mean, as soon as you have 2, 3, 4 production coming on stream, Generali's and Index is working on that already, working on advanced index. So it can be quick, but we need more transparency on production.
Yeah. Gaynor, I think there's a few questions.
Quickly,
oh, yeah,
very quickly, just to add. So from my practical experience, even in oil industry, we're trading jet fuel right now. There are some markets, they are not based on some indexes. It's a refinery price. You get refinery price and no indexes. And the market is working well.
Thank you. Gaynor, there's a few questions around the RCM. So will it make us uncompetitive? How will it drive down costs?
I think all those questions have my name on them, actually. Maybe a factor of me not having explained it terribly clearly at the very beginning.
Not enough time.
The RCM, the UK's RCM definition of a fuel supply is a SAF fuel supply. That is an obligated party, the obligated party that has the SAF mandate obligation. And what I should have said is when the market is long, you would expect the achieved sales price to go down, and that's when the levy is needed to top the price that the SAF producer gets up to their strike price. If the market's short and that price goes up, the other side of it is that some money would have to be paid back to the counterparty, who would then distribute it back to the levy payer, in other words, the oil companies, the obligated parties, who are then expected to pay that back to the airline. So in terms of downsides, I mean, that could be viewed as a bit of a downside for a SAF producer in that they can't have as much of a share of the upside as they would want, and that may limit them being able to bring in the equity. But it's not necessarily the case that 100% of the volume of outputted by the SAF producer would have to go through the revenue certainty mechanism. So, I mean, if a project has, say, 60% project finance of 40% equity, perhaps 60% of the volume of the output could be sold under the RCM contract, and the rest could be open to be sold wherever, and the upside taken by the equity investor. So that's one aspect. I don't think the UK government could possibly limit imports in order to kind of create the need for projects to be built in the UK to meet demand. I mean, that would not work. And someone's kindly mentioned the recent US trade deal with ethanol. I mean, it's not just threatened ethanol production. For anybody who doesn't know, the UK-US trade deal that was agreed on the 8th of May sold the entire ethanol market demand in the UK as tariff-free. So that can all come in tariff-free from the States, which is disastrous for the UK ethanol producers. And we're just dealing with the implications of that now.
Something I'm asked, actually, Gaynor, is whether the RCM would only apply to projects that are in the UK.
Absolutely. That's the whole point of it.
Yeah. I am actually asked the question by people who are developing projects elsewhere whether they could tap into the RCM.
Absolutely. And I think that one of those questions about sort of what is the global plan here, because there's a lot of inconsistency, and I think a variety of things that are not thought through. I'm not clear at all that when the US brought forward all the tax incentives that they have brought forward for the development of renewable energy and SAF and so on, that they expected the decarbonisation value of those projects to be exported. Now, Trump may not care about that. We may be in a post kind of decarbonisation world from his political view, but certainly the convention at the time would have been, we're going to advance these projects to promote decarbonisation in the US. Yeah. What's happened is it's very lucrative to produce there. It's even more lucrative if you sell somewhere else because you can double up on your mechanisms and your subsidies. So that's creating a global trade flow in these fuels that was not expected, and is an example of what happens if you set things off in a particular direction where there may need to be a change of law and a course correction. Yeah. I think on the RCF specifically, there's a small risk of of a loss of kind of innovation in pricing. I think the basis of any contract for difference is that you're assumed to capture a market reference price. So you have to conclude an offtake on that footing. If you were thinking that you could have done a different deal with a price cap or a price floor or rolling other elements into the transaction, you can't do that because then you won't be treated as having captured that revenue, so you'll create a hole in your economics. But the massive advantage that it brings outweighs that by miles, I think. And you only need to look at the UK offshore wind market where prices have dropped from the original sort of 2014 strike prices of 150 plus pounds a megawatt to 40 or less to see what the cost reduction pathway can be with a contract for difference.
Yeah. And there's talk about revenue certainty mechanisms at a European level, I think through projects Sky Power, Sky Energy, through double-sided mechanisms, a little bit like the H2 Global scheme, which has been going for a while. So I think we'll see maybe this expanding beyond the UK into Europe, I think, which is a very important mechanism. I think we've run out of time, but I'd like to give the panelists just a final word if there's anything that they would like to chip in on in terms of the discussion we've been having and any final comments.
I'll go first, maybe, but what I want to leave the audience with is there is increasing confidence in SAF by investors. The risk and return balance, thanks to the mandates, is starting to hit the right point. So investors, keep a lookout on SAF, keep coming to conferences and keep your interest up because transactions will come up soon.
Thank you.
I stick my neck out, I think, a little bit and say, I think there's a risk here that the regulatory regimes globally are putting SAF onto the wrong flights at the wrong airports. It doesn't really follow the commercial logic to push flights, for example, onto intra-EU, push SAF onto intra-EU flights because that's the greatest way of offsetting the ETS cost that would otherwise arise, when airlines might want to put them onto long-haul flights where they have high-paying business passengers who they can sell kind of offsets to. So I think there needs to be a lot of rationalization of the commercial model against the regulatory support. Different approaches, even at the fundamental level of what SAF is globally. So we need to start to harmonize some of that so that the market can begin to operate efficiently. But I guess that's what we're all here to contribute to.
Anything else?
Oh, coming back on the question this morning of optimism on SAF in 2025, I think, well, I said not really optimistic, but when I see the level of discussions and progress that we are making and the willingness is there, I think let's be more, I'm a bit optimistic.
Yeah, and I think the regulations and the other mechanisms need to increasingly drive the participation of the entire supply chain, like the oil and gas companies. You know, there was an interesting session before with the absence of oil and gas companies, but I think at the moment their lack of maybe engagement sometimes with the sector is due to the fact the system is not designed in a way to make them participate as much as they should be. So I think we've had a great discussion. I'd like to thank the panelists for their contributions and their very broad perspectives. So thank you very much, and join me in thanking them. Thank you.